It's a typical I told you so story. Analysts who were drowned out in the euphoria of new age tech IPOs are having their voices heard again. One such voice is Saurabh Mukherjee of Marcellus Investment Managers, who had warned investors against investing in companies without a positive cash flow. Business Today TV's Rachna Dhanrajani caught up with Saurabh. Listen in.
I've never quite understood why people spend so much time thinking about the level of the stock market. To the extent you have a country where the economy is growing 6-7% at real terms, corporate earnings are growing 15 to 20%. Naturally, the stock market will oscillate up over. The stock market will grind up over time. The issue is not whether equities will hit fresh highs. They will hit fresh highs repeatedly in your and my lifetime. The question is, can you and I and your viewers, can they make money consistently from investing in the Indian market? The Marcellus proposition has been, yes, you can make money consistently in the Indian market if you invest in companies which are clean, well managed and have dominant franchises. So distinct from whether the market will go up, yes it will. Distinct from that is the question, can you consistently compound? Our proposition is yes you can, and that's something which we've written about in our books, whether it be Diamonds in the Dust or Coffee Can Investing.
We see this trend that the startups that we 1 year ago saw get listed on the BSE or the NSE, and now where the lock-ins have ended, the valuations have dropped. What do you have to say about that?
Nothing new here, right? Every decade, the Indian stock market finds a new paradigm to get worked up about, and then the paradigm crumbles in less than a couple of years. We saw this same story play out with power and infrastructure, and the movie's replaying this time with tech-enabled stories. If a company doesn't generate cash flow, if a company has never generated cash flow, it's unlikely that it will generate cash flow after you buy, right? So everybody cites companies like Amazon, and on the back of the one spectacular Amazon, a lot of other low quality companies have floated. But there's only so much lipstick you can put on a pig. And I think our stock market has probably done that in a little bit of excess. Yes, there'll be successful tech-enabled companies in our country, but out of every 10 aspirants, one will succeed, the other 9 will destroy your wealth. And therefore, again, I go back to the same proposition. Look for companies cleanly managed, competently run, dominant franchises, and the dominance manifesting itself in superior cash flows coming out of the company. Very few tech-enabled companies have done that, unfortunately.
2020 was a year where Indian markets outperformed its global peers. Do you see this momentum sustaining, or where do you see we're headed now?
So as I just said in the presentation to PMS Bazaar, right, our point of view is that what we are going through is very similar to America in its heyday, 1880 to 1930. We're joining the country up, not just physically joining it up, financially joined up, digitally joined up, tax evasion is being cracked down upon, we are formalizing the economy, cost of capital is coming down. This confluence of factors is very, very powerful. Very few large economies can hit so many buttons at the same time. Given that the rest of the world doesn't seem to have anything remotely comparable, my reckoning is for several years to come now, India will be the world's fastest growing large economy.
You said while investing, we must have 3 categories where we should judge the company by. It should be clean, it should be clear. If you could expand on that, and which are these companies that you see in the current times?
Right. So the cleanliness aspect is the account should be clean. The promoter shouldn't be stealing from the company's books, right? Self-evident. If you give your money to a crook, you ain't going to see your money ever again. Secondly, you need to see a track record that the promoter, the management team actually is competent. And the simplest way to assess that is look for companies where return on capital exceeds the cost of capital over long periods of time. There are actually very few companies in India which meet these first 2 criteria. If you ask me, in my 14 years in the country, I've seen no more than 60 companies who meet this double criteria. In addition, to compound your wealth over and above cleanliness and good management, you're looking for dominance. The simplest way to understand dominance is you're looking for companies who charge their customers 20, 30, 40% higher than what the competition charges, and yet not a single customer walks away, right? So if you get these 3 ducks lined up, clean, competent, dominant franchise, it is relatively hard not to make money, provided you're a patient investor.
What do you think one should do in this entirely new age tech space where the doors for selling have just opened up?
As I said, if a company doesn't make cash flow, it's not really a business that I can invest in. So difficult to sell something that we haven't bought, and you know, I simply can't get my head around how people buy companies which don't generate cash flow. To be fair to investors in tech, this is a standard challenge in Indian markets. Even in sectors like power and infrastructure, broadly in the Indian stock market, free cash flow generation is very scarce, right? If you take the BSE 500, there'll be barely 60 companies which generate cash with any frequency.
If you like the video, do like, comment, share and subscribe.